Welcome to the October 29th, 2018 Advance Report from McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, president, McGowanGroup Asset Management. This, an important tour of the global financial markets after an equity smackdown that shocked even the most seasoned investors. This week, we saw the Dow Jones Industrial Average decline to about 24,500 at the low point, nearly fulfilling the definition of an official correction. A bear market's 20%, a correction's 10%. Leading the way was technology. And invariably, when you have thin leadership, as we pointed out about 6 months ago, the tech was leading everything. And it was only a handful of stocks, Facebook, Amazon, Apple, Netflix, Google, and a few others in the FANG index, that were leading the charge that took the index to about a plus 10% gain for the year. That totally wiped out the Dow, falling into negative territory at the lows of the week. What's ahead for 2019? An important subject. Let's go diagnose this air pocket that the markets hit. This is the FANG index, the technology stocks. On Friday, you got a read on what's actually happening. Despite stellar results, a tenfold increase in net income for Amazon, Amazon got smacked down by 10% at the open on the last trading day of the week. Similarly, Google reporting good progress, not enough for investors, sold off 5%. Facebook hit a 52-week low simultaneously, down 3% on the trading day, but down 17% since the start of the year. The technology rally is clearly over, at least for the time being, and you can see it in the FANG index falling to an 18% loss from the peak. And that's something that weighs on the minds of investors who were enjoying a magic carpet ride all the way through May 31st, now substantially below that by nearly 20%. That correction changes the market leadership. Where is this thing going to go? Let's take a look at interest rates, put it in perspective, and I'll highlight two asset categories that we're using to maximize future income and gain potential after this smackdown. This is the 30-year U.S. Treasury, 3.3% closing the week. They were buying treasuries out of fear, it looked like, this week. And this is the T-bill rate, rising steadily with the Fed funds short rate. Notice long rates stable, up slightly, but you've got a huge increase in percentage terms in the short interest rates. That means that the Fed is getting close to the end of this cycle. Let's triangulate the next 6 months and turn it into strategy. All right. These are the probabilities of a Fed hike. Well, November 8th, 95% likely that the Fed stays at the 2% base rate where they have the current interest rates. 2 to 2.25 is the range. Now, we go out to December meeting, 2/3 likely they go to 2.25, 2.5. But what happens after that? Remember, the 30-year Treasury only 3.3%. That's called flat, and it's almost too flat. Well, there are no probabilities that indicate a rate increase after the 2.25 that we see in December. So there are two bargain categories. If the 30-year Treasury has risen to just 3.3%, anything paying over 7% could be a relative bargain. Plus, if you put it into a portfolio and the current income stays at 7 or better, well, then you're likely to have something over 70% on a 10-year time horizon, and potentially a gain when the Fed says we're done putting pressure on the cash flow assets. Two bargain categories we're going to talk about this week. The first in fixed income. Global high yield has moved to about a 75% discount to the par value that you get paid on in a basket of well-managed loans and bonds. And the income levels, in some cases an astounding 9 or 10% in real interest while you wait for a potential gain from the discount to par. That's global high yield. Energy infrastructure. What do you do to prepare for a correction or a range-bound market? As we told you this could be back in January. Well, it looks pretty range-bound now. Well, the category that already had its bear cycle, energy, but specifically energy infrastructure because of the cash flow, in many cases 8, 9, and 10% in a diversified portfolio that owns energy infrastructure at prices with substantial gain potential, even if oil falls to $60 a barrel. If they catch up to where they were when oil was 27, substantial gain potential and incomes well over 7% in both categories. Prepare for your future with a time horizon of 5 to 10 years. Join us at NetWorthRadio.com for the extended version, plus more charts, graphs, and research to help you make great investment decisions. My mission is the financial weatherman. Join us each and every week right here on YouTube and at NetWorthRadio.com. My firm, McGowanGroup Asset Management, sponsors NetWorthRadio.com and, of course, our YouTube channel under McGowan Group. Some educational disclosures and discussions that I wanted to add to the broadcast. The first is, I'm very proud of our team, including Stephen Norris, who will be added as soon as we redo the picture. He's our newest team member. Come down, meet the team that cares, get a written plan, because the securities we discuss, the financial news we discuss, that's not a recommendation until you actually come down and get a customized plan at the Crescent. You'll get a tour, and we look forward to seeing you. We're going to cover value at risk of loss in portfolios, and you can see it right here. Learn about our performance, what happened in 2008, how long did it take to recover. All of those items are posted right here at NetWorthRadio.com or the McGowanGroup.com. The other part of the program, when we look at price fluctuations in bear markets and risk control, that's a huge part of NetWorthRadio.com. We look forward to helping you advance your plan and your cash flow. Come down and meet the team that cares.